the mistakes made by our people running some of our major financial institutions, by small and large banks across the country, and the mistakes made by people in government responsible for overseeing that system were catastrophic. And it was absolutely essential that as we put out the financial fire, which we have done at much lower cost, much more quickly, much more effectively than anybody thought was possible, that we change the basic rules of the game in which institutions operate. And I believe, but I'm going to take the optimistic side of this debate, that the reforms Congress passed this summer are the most powerful, the most effective, I think a model for the world in how to make sure you bring a more modern structure of oversight to a market-oriented financial system. And we've already moved very quickly to raise capital requirements on banks, to reduce leverage, to make sure they're operating with much stronger financial cushions against whatever the uncertain source of risk we face in the future. We're moving very quickly to make sure consumers have access to much better disclosure about the basic terms of a mortgage or a credit card. And we now have the tools we did not have before the crisis to make sure that we can dismember a large institution that managed itself to the edge of the cliff, to make sure we can dismember them safely at less cost to the taxpayer, less damage to the economy as a whole. So that imperative of financial reform quickly was very important, and I'm much more confident now because of those reforms that we're going to have a financial system that can go back to being the envy of the world and do what it exists to do, which is to take the savings of Americans and channel those to businesses that have some idea that need to grow. We were once the envy of the world in doing that. We lost our way, and we're going to make sure we go back to a country with a system that serves that basic function better. And of course, we're very worried about trying to make sure that the regulations that implement the new rules come out in a way that has the right balance. What's the right balance? Again, you can't look at our system and say we did an adequate job of protecting consumers and investors. We have to be better at that. That's an overwhelming economic imperative. And we also got to make sure banks run with less leverage. And we have moved very quickly to provide clarity on what those new rules are going to be and give banks the time to catch up, build capital to meet those new standards. And the virtue of having a transition period like that with clarity is people know what the rules are, know what they have to plan to, and that reduces the risk that as we build a more stable system, we're not reinforcing the kind of headwinds that could slow the economy going forward. Of course, people want to know what the details are going to be for what the new rules on derivatives are going to be, for example. And that's a complicated business, and you want people to get those things right. Take some time to get them right, but we're going to move as quickly as we can. And of course, we recognize and we believe that clarity sooner in those areas would be good. But I'm very confident these reforms will help make this system a more resilient, more stable, but still remarkably innovative financial system. And we're going to work very hard to make sure the rules meet that test. This crisis has been incredibly devastating. It's touched the basic fabric of our country like nothing we've seen since the Great Depression. And it's not just that unemployment is 10%, because as you know, in communities across the country, it's substantially higher, 50%, double that, and it's very concentrated in particular industries and sectors. And so that unemployed auto worker is in a situation like many people in construction, lots of other parts of manufacturing, and it is just one example of how powerful and damaging this crisis has been. And I think the only answer you can say is that it is important that we all recognize that the government has more work to do to solve these problems, to repair the damage, to get those people back to work as quickly as possible. This is going to take a long time. There's no easy, quick fix, but Washington's job is not over, and we're not going to be able to offer those people a quicker path to employment if people decide that our challenges now are, well, how should I say? Well, I don't want to make a political observation, so I won't do that. That the government's role right now is to figure out how to preserve tax cuts for the richest 2% of Americans. It's not a responsible, defensible strategy for a country that's living with such huge damage caused by this crisis. The big mistake we made in our financial system is to allow, the basic architecture of oversight to get a little rusty, to let the moss accumulate. I'm mixing metaphors. And to allow a huge industry of finance to build up outside the protections we established for consumers, investors, and against excessive risk-taking and leverage. We had a system designed to constrain risk-taking for banks that was refined and strengthened after the S&L crisis, our last major banking crisis, which is a rather mild and quaint crisis compared to this. But we let a huge industry of risk-taking and finance to build up outside those protections. And that mistake was catastrophic. And it's just obvious how that happens. If you have rules here and no rules here, all the risk will move to where there's no rules. And those institutions able to operate without restraint will take business away from the institutions you regulate. Now, the rules for banks obviously were not tough enough or well-designed either. So both mistakes were consequential. Canada looks like a much more boring, in an envious way, financial system, more stable. They had essentially 5 institutions who provide credit, not 9,000, and they made sure that they constrained the amount of risk they were able to take against capital. It sounds simple, but if you get that right, you can prevent a lot of damage. You can't run a financial system on the expectation you have a bunch of government officials who sit at their desks and try to imagine the next potential crisis, try to figure out what type of innovation today may cause catastrophic risk in the future, what's the likely source of the next recession. The smartest people in the world will not be consistently good at doing that, and even if they were consistently wise with foresight, they wouldn't necessarily have the tools or the power to act preemptively to preempt those types of risks. The most important thing you can do about these things is to force your financial system to run with bigger shock absorbers, bigger cushions against leverage and risk-taking. If you get that right, you won't solve all problems, but you'll make your country, as we have now done, much less vulnerable to a future crisis. An irony in this crisis is this crisis started in July of 2007 when you had a classic run started by the European institutional investors, money market funds, that had helped a bunch of affiliates of German banks buy a bunch of subprime real estate in the United States. And the size of those losses for German banks were very, very large, larger as a share of the economy than even the losses we faced in this crisis. So even there, in a much more conservatively managed financial system with far fewer institutions and a much larger role of public banks, you saw banks take on a huge scale of losses. And in fact, the scale of losses relative to the size of their economies, that the United Kingdom, that Switzerland, that Germany, other parts of Europe, not just Iceland and Ireland, Spain, Greece, faces a share of their economy were much larger than even what we faced here in the United States because they were not careful enough about getting ahead of that huge increase in leverage soon enough. Well, you can't affect what people aspire to. And people will always aspire to own their home. I think that's likely nothing wrong with that. What the United States did was to provide very expensive, generous subsidies in a variety of forms to lower the cost of home ownership. They did this for a bunch of noble objectives. One was to make sure that low-income Americans had better access to affordable housing, but they also did it because they thought that the basic economic security of a middle-class family would be enhanced by owning a house with the chance to earn equity over time. But we got that balance wrong, and we're in the process of correcting that now. And although the financial reform bill, Dodd-Frank bill, didn't take on all of this challenge now, we're going to propose in the early part of next year reforms to the broader housing finance system, including how to reform's not quite the right word, how to replace Fannie and Freddie with a more stable system that has lesser risk of getting this balance wrong in the future. To oversimplify a bit, the government allowed them to make 2 very costly mistakes. One is to build up a huge portfolio of investments that they used to try to give higher returns to their shareholders that had a lot of risk in them. And the second was, as the private banking community lowered underwriting standards to try to capture a bigger share of the business that was being competed away from them by the unregulated industry, Fannie and Freddie followed the market down. So they took on much more risk in lending to housing than they had capital. And in Washington, as you know, Washington did not require them to hold more capital against those losses. And so they came into the crisis the most exposed to the risk of a sustained collapse in housing, a long period of high unemployment, with very thin, almost no capital to back those up. And that is a mistake we can easily avoid in the future. To do that, it's not rocket science. We have much harder things to figure out as a country. That's something we can change. We have to make sure we take out those decision-making away from politics in Washington so that politicians don't have the ability to use those institutions for objectives that they weren't designed to meet. And we've got to make sure that they can be forced to run with less risk, just to repeat a consistent theme. It's not rocket science. Japan, as you know, got itself in a situation where they had a huge, unsustainable financial real estate bubble. That was a product of a lot of policy decisions in the decade preceding. And when the world turned and that bubble collapsed, it suffered a very, very deep recession. But what's been remarkable is how long that lost decade, more than a decade of growth, has been, how long it's persisted. And that would have been a very difficult challenge for any country to manage. And so what I'm about to say, is not, I don't mean this to be critical of them, but I would say the basic lesson from these kind of things, and this is the judgment of strategy that informed what the president did in this crisis, is that when you face a crisis like that, you have to move very, very quickly to put overwhelming financial force to break the back of the financial panic, to make sure you're trying to fix the stuff as quickly as you can, to make sure you take the leverage out of the system as quickly as possible, that you restructure the system to take out the weakest parts. If you adopt the alternative strategy, which is to wait, to be more gradual in how you escalate, to hope it's going to heal itself, to hope you can grow your way out of the large losses banks take on in that context. If you're not aggressive with the full arsenal of tools governments have, then you will be consigned to a long period of underperformance and growth. And just to go back to what I said at the beginning, you can see in how the economy is recovering in the United States the benefits of an alternative strategy. We had growth come back much more quickly in the United States. You saw the cost of credit fall much, much more quickly than happened in the Japanese experience or elsewhere. You saw businesses start to invest again and hire much earlier than even we saw in the much moderate recessions of our last two recessions. And that's because policy in the United States was much more aggressive, much more nimble, much more carefully designed. And because we as a country we let those tough restructuring, tough adjustment, that reallocation of capital happen with much more force. It makes it much harder in the short term, but it's much better for the prospects of actually coming out of this durably with growth at a more sustainable level going forward. And we are not consigned to repeat that future. Washington's work is not done. There's still more work you have to do to reinforce the recovery underway, but we're not going to make that mistake.